Welcome back to another explainer. Today, we're tackling a massive, and I mean literally massive topic. We're going to completely demystify the financial markets and transform how you look at trading. We're taking it from a reckless gamble to a highly disciplined strategic profession. If you've ever stared at the chart, felt totally overwhelmed, and wanted how the pros actually make a living doing this, well, you're in the right place. We are breaking down the master trader's comprehensive blueprint, handing you the exact roadmap to take you from a complete novice to a consistent, profitable trader. Let's get into it.
So here's how we're going to get you there. We've structured today's explainer around 5 core pillars. First, the reality of trading. Second, the trader's toolkit. Third, defending your capital. Fourth, mastering trading psychology. And finally, your 90-day blueprint.
Let's kick things off with pillar number 1, the reality of trading. It's time to shatter those illusions of overnight wealth and lay down a really solid, grounded foundation.
Think of trading like the world's largest, fastest digital marketplace. At its absolute core, it's just the methodical buying and selling of assets to profit from price movements. That's it. Whether the market is flying high or crashing down, traders are looking to capture just a little piece of that movement. And this whole thing happens across a bunch of diverse financial ecosystems. You've got Forex for global currencies, the stock market for company shares, crypto for digital assets, and commodities for physical stuff like gold and oil. But listen, the mechanics, they always stay the same. You're buying low and selling high, or selling high and buying back lower.
But right here is where 90% of beginners get it totally wrong. Look at the amateur. They step into the market acting like a straight-up gambler. They're relying entirely on luck, they let fear and greed drive every single click, and they completely ignore safety nets like stop losses. It's wild. The master trader, though, they operate in a completely different universe. They rely on mathematical probabilities. They're deeply disciplined, and they use strict risk management on every single trade. They honestly don't care about being right on just one trade. They care about their statistical edge over, say, 100 trades.
Now, what's really interesting is this 5 to 10% benchmark. Seriously, ask an amateur what they want to make, and they'll probably tell you they want $1 million by Friday, right? But a true professional focuses on realistic, consistent monthly returns, usually benchmarking around 5 to 10%. And let me tell you, compounding those realistic percentages over time, rather than just hunting for random lottery tickets, that is the real secret to surviving and thriving in the markets.
Which perfectly tees up our second pillar, the trader's toolkit. Because if you're going to extract those steady percentages from the market, you absolutely need the right analytical weapons.
The first major tool in that kit is technical analysis. Think of this as the art of reading the market's footprints. By analyzing historical market data, checking out candlestick patterns, finding levels of support and resistance, and drawing trend lines, professionals can actually forecast where the price is statistically most likely to go next. Honestly, it's not magic. It's literally just recognizing repeating patterns in human psychology, all visually represented right there on a chart.
To help read those charts, traders layer on key technical indicators. And no, you don't need 100 of these cluttering up your screen, just a few really reliable ones. You've got the RSI, or Relative Strength Index, which basically tells you if an asset is overbought or oversold. The MACD shows you the momentum. Moving averages smooth out the price action so you can actually see the real trend. And Bollinger Bands help you spot market volatility. When you put them together, these tools are fantastic at highlighting high probability points to enter and exit your trades.
Now, while technicals show you what is happening, fundamental analysis tells you why it's happening. This is all about evaluating an asset's true intrinsic value based on real-world data. Think about things like major economic news, central banks tweaking interest rates, inflation data, GDP growth, or even just a specific company's quarterly earnings report. These are the massive macroeconomic forces that create huge waves in market sentiment.
And depending on your personal vibe and your lifestyle, you're going to apply these tools to totally different time frames. For instance, scalping involves trades that last mere minutes. It is high energy and super intense. Day trading means opening and closing your positions within a few hours. Now, if you have a full-time job, you might lean towards swing trading, where you hold trades for days or even weeks. And finally, position trading is for the incredibly patient, holding assets for months or years to ride those massive macroeconomic trends we just talked about.
All right, moving right along to pillar 3, defending your capital. And listen, if you only take one single thing away from this entire explainer today, please let it be this. In trading, offense might win games, but defense absolutely wins championships. Your capital is your inventory. Without it, you are literally out of business. And this brilliantly illustrates the basic math of survival. We're looking at a 1-to-3 risk-to-reward ratio. Your risk is strictly capped at 1%, while your target reward is 3 times that size, at 3%. When you structure your trades exactly like this, it's wild. You could literally lose 70% of your trades, and because your winners are mathematically so much bigger than your rigidly controlled losers, you still come out profitable. Isn't that crazy?
To actually enforce that math, professionals follow strict risk management mandates. Number 1, always, and I mean always, use a stop loss. This is an automatic order that exits the trade if it turns against you, which stops a tiny paper cut from turning into a blown account. Number 2, define your take profit levels before you even click buy. Number 3, use strict position sizing. And lastly, number 4, never ever risk more than 1 to 2% of your total account equity on any single trade. These are the absolute non-negotiable defensive shields of every pro trader out there.
Now, even with the most perfect technical setup and rigid risk management, traders still fail. Why? Well, that brings us to Pillar 4, mastering trading psychology. Because honestly, the hardest battleground in the markets isn't the chart at all, it's your own mind.
Every single day, traders are fighting a massive tug-of-war between two emotional demons, fear and greed. It's basically human nature actively trying to steal your wallet. Fear makes you panic and sell at the absolute bottom, or it paralyzes you entirely so you miss perfectly valid entry signals. Then there's greed. Greed is that little voice whispering in your ear to hold a winning trade way too long until it suddenly reverses. Or it tricks you into over-leveraging your account chasing massive profits. And yeah, that almost always results in a total wipeout.
So the crucial point here is recognizing how these emotions show up as common beginner pitfalls. We see it literally all the time. You've got FOMO, the fear of missing out, where you blindly buy the top of a huge green candle right before it crashes. Then there's revenge trading, which is when you try to win back a loss immediately by jumping into a really stupid trade. Add in overtrading just out of sheer boredom, operating without a written strategy, and having completely unrealistic expectations. Well, it's a guaranteed recipe for failure.
So how do you actually conquer those emotions? You do it by replacing that emotional chaos with systemic, analytical thinking. Pros follow a super rigid daily routine. Step 1, market preparation, like checking the morning news. Step 2, chart analysis, marking out your key levels. Step 3, trade execution, where you follow your plan with zero hesitation. Step 4, detailed journaling of every single trade you take. And Step 5, an end-of-day review to analyze what worked and what didn't. You see, routine builds discipline, and discipline completely removes the emotion.
Okay, we've covered the reality, the tools, the defense, and the mindset. Now it's time for our final pillar, your 90-day blueprint. This is the exact actionable roadmap you need to take everything we've just talked about and put it into real-world practice.
Think of this like your personal trading bootcamp. Month 1 is dedicated entirely to market foundations, learning how to read candlesticks, studying market structures, and just getting a grip on the core terminology. Month 2 shifts gear into strategy development. This is where you pick a few indicators, define your strict risk rules, and physically write down a specific trading plan. Then, Month 3 is the most critical phase, demo trading. You're going to use fake money and real market conditions to test your strategy. And listen to me very closely here. You do not touch real money until you are consistently profitable in demo.
Let's move to the actual setup and see how this builds your digital trading desk. And spoiler alert, you don't need 6 massive monitors to do this. You just need the right software. The industry standard for charting is TradingView. For actually executing your trades, platforms like MetaTrader 4 or 5 are pretty ubiquitous. You'll also need to bookmark an economic calendar so you can dodge high-impact news events. And you absolutely must use a trading journal, whether it's fancy software or just a simple spreadsheet, to track all your performance data.
When you are finally ready to cross that bridge from education over to live execution, you've got to follow these exact sequential steps. First, ensure you've mastered the basics. Second, have your trading plan fully documented. Third, carefully select a reputable, regulated broker to hold your hard-earned funds. Fourth, prove you can hit that consistency on your demo account over an extended period. Only then, at Step 5, do you transition to a live account. And even then, you start with very small capital as you adjust to the heavy emotional weight of real money.
All of this perfectly encapsulates the core thesis of our explainer today. As the source material so firmly states, trading is not a get-rich-quick scheme. It is a profession of discipline, risk management, and continuous learning. It's a real skill that takes serious time to forge. It requires the dedication of a seasoned professional, not just the blind luck of a gambler hoping for a quick payout.
We've laid out the tools, the defense strategies, the psychological pitfalls, and given you the exact 90-day roadmap. The blueprint is fully yours now.
The only real question left is, do you actually have the discipline to follow it?